Welcome to the deep dive. Today, we're looking into a specific trading strategy. It's called buying the retest.
That's right.
We think it could be pretty useful, especially if you're trading the Nifty 50. We've got some info here detailing how it might offer, let's say, a better entry point with a more defined risk.
Yeah, the idea is to try and stack the odds a bit more in your favor.
Exactly. So our mission is to really unpack this step by step.
Let's do it. The core idea is, well, pretty straightforward, really. After a price breaks through a resistance level.
Like a ceiling it couldn't get past before.
Precisely. After it breaks through, it often tends to pull back. It comes back down to check that old ceiling.
Which might now act as a floor, a new support.
Exactly. That old resistance becomes potential new support.
Hmm.
Buying the retest is about spotting that pullback, seeing if buyers actually hold that level, and then, considering a long position.
Hoping the original upward move continues.
That's the plan. Capitalizing on that momentum after the breakout gets, well, validated by the retest.
Okay, step one then. Actually spotting that initial breakout on the Nifty, what does that look like? What are we searching for?
You're looking for the Nifty to clearly break above a level where it's struggled before. Could be a horizontal price level or maybe a downward sloping trend line.
And it needs to be decisive, right? Not just poking its head above for a second.
Absolutely. You want a convincing break. Think strong volume behind the move. More people trading than usual.
And the price move itself.
Should be solid. A decent percentage gain on the candle, maybe closing near its high. Our source material actually gives an example.
Oh, yeah.
Yeah. April 10th, 2025. Nifty apparently broke above 22,500. It had been stuck below that for like 6 weeks.
Okay.
And the breakout happened with a 1.5% jump, and a volume was like 60% higher than average. That's the kind of decisiveness you look for.
Got it. Strong break, good volume.
Yeah.
Check. What's next? Do we just jump in?
Not quite yet. Patience is key here. First, you want to check the broader market context. Is the overall environment actually supportive of prices going higher?
What sort of things are we checking?
Well, general economic news, is it positive? Are global markets stable or are they shaky? And crucially, volatility.
The VIX.
Exactly, the India VIX. The source suggests avoiding really high volatility. Ideally, maybe keep it below, say, 20 or 22. High VIX can mean erratic moves, which aren't great for this setup.
And in that April 2025 example, what was the context like?
It was pretty supportive, according to the source. Q1 earnings in India were apparently strong. Foreign investment was flowing in. The VIX was calm, around 17.
Okay.
And the Nifty itself was trading above its 50-day moving average, which is often seen as a bullish sign too.
Right, so the background checks out. Now we wait for the price to come back down, the retest itself.
Yes. Now you monitor closely. Watch for the price to drift back towards that level. It just broke the 22,500 in our example.
And what are we looking for at that level?
Signs of rejection.
Yeah.
Signs that sellers tried to push it back below, but buyers stepped in. You look for specific candlestick patterns.
Bullish ones, like a pin bar maybe, that
Yeah.
long tail at the bottom?
Perfect example. A pin bar, a bullish engulfing pattern. Maybe it just makes a higher low right near that breakout level. These suggest buyers are defending the zone.
And volume, does that play a role here too?
It does. Ideally, you want to see volume decrease during the pullback. That suggests sellers aren't that enthusiastic.
Less conviction on the way down.
Right. And then importantly, you want to see volume increase when the price starts to bounce off that level. That shows buyers are come back in with force.
So what happened in the example on the day after the breakout, April 11th?
The Nifty pulled back, touched near 22,510, so just above that old 22,500 resistance. It formed that bullish pin bar we mentioned.
Okay.
And then bounced back up towards 22,600. And critically, volume was lower during that little dip and picked up on the bounce.
Okay, so we've seen the pullback, we see signs, buyers are holding the line. How do we get the final green light, the confirmation?
You want to see that initial bullish sign, like the pin bar, followed by more strength. Maybe the next candle closes strongly higher. That increasing volume on the bounce is a big confirmation signal.
Anything else?
Yeah, a couple of things can add confidence. Is there a clear path upwards? Or is there another resistance level just immediately overhead? You want some room to run.
Makes sense.
And sometimes indicators can help. Like if the ADX indicator is above 25, it suggests a strong trend might be in place. Or maybe a moving average, like the 20-day EMA, is sitting right there providing support too.
And in the example, did those line up?
They did, apparently.
Ah.
After the pin bar, the price closed strong. Your 22,600 volume picked up. The ADX was at 27, suggesting trend strength, and the price stayed above its 20-day moving average.
Plus, the next likely resistance wasn't until around 23,000.
Right. Breakout, context check, retest observed, confirmation signal seen. Now, finally planning the actual trade. Entry, stop, target. Okay, entry. A common approach is to enter once a bullish candle closes above that breakout level after the retest happens. So maybe around that 22,600 in the example.
Stop loss, your safety net.
Crucial. You place it below the low point of that retest dip, or maybe below the most recent swing low, just to give it a bit more room. The source even mentions using the ATR average true range.
To account for normal volatility.
Exactly. Like maybe set at 1.5 times the ATR value below your entry. If the APR is 100 points, your stop is 150 points away. Helps avoid getting shaken out by noise.
And the target. Where do we aim?
That depends. You could measure the height of the previous consolidation range and project it upwards. Or use Fibonacci extension levels.
Yeah.
Or simply aim for the next major obvious resistance level.
Like that 23,000 or 23,200 mentioned.
Right. The key thing is the risk-reward ratio. You want your potential profit to be significantly larger than your potential loss if the stop loss gets hit. Aim for at least, say, 1 to 2, meaning you stand to make twice what you risk.
So in the example, entry 22,600, stop around 22,450, 150 points risk. Target 23,200, 600 points reward. That's 1 to 4.
Yeah, that's a very favorable ratio.
Okay, plan is set. How do people typically execute this? Futures. Options.
You have choices. Nifty futures work. ETFs tracking the Nifty. Or options. If using options, the source suggests maybe an at-the-money or slightly out-of-the-money call, perhaps with an expiry 1 or 2 weeks out to give the trade time to work.
And position sizing is key, I assume.
Absolutely critical. Only risk a small percentage of your trading capital on any single trade, maybe 1% or 2%. That way, even if a trade goes wrong, it doesn't hurt too much.
And managing it once you're in.
You could consider trailing your stop loss up as the price moves in your favor, lock in some profit, and then you exit either at your predefined target or things start to look shaky, maybe momentum fades or the market turns.
What are the main risks? When does the setup fail?
The big one is a failed retest. The price comes back to the breakout level, pauses, but then slices right back down through it, often with high volume. That invalidates the setup.
So you gotta respect that stop loss.
You absolutely have to. Other risks. A sudden spike in volatility like the VIX shooting up, or just broader market sentiment turning negative because of some news event. Always need to keep an eye on the bigger picture.
Okay, so recapping the core idea. Buying the retest is really about discipline. You identify a strong breakout with volume, you confirm the market context isn't hostile, you patiently watch for that pullback to the breakout level.
You look for signs of buyer support, holding that level, with confirming volume and price action.
And then you plan and execute with a clear entry, a defined stop loss, and a logical target, always managing your risk.
That's it in a nutshell. It's trying to get confirmation before jumping in, hoping to catch the continuation move.
It definitely gives you something concrete to look for, which leads to a final thought maybe. How would this strategy adapt to different time frames? Trading off an hourly chart versus a daily one.
That's a great question. The principles might hold, but the noise level and the required stop-loss distances would likely change.
And could you apply this same retest logic to individual stocks within the Nifty, factoring in their specific news or sector trends?
Potentially, yes, though individual stocks have their own idiosyncrasies. Definitely something interesting to explore further.
Food for thought indeed. Well, thanks for breaking that down with us today.
My pleasure.